Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Vail Resorts Inc. quarterly report. Vail Resorts Inc. provides a wide range of businesses and services across its three main segments: mountain, lodging, and real estate. The mountain segment offers various activities such as ski school, dining, retail/rental operations, and real estate brokerage activities at its destination, mountain resorts, and regional ski areas. This segment is the core of Vail Resorts' business, providing a unique experience for customers to enjoy skiing, snowboarding, and other winter sports. In addition to the mountain segment, Vail Resorts also operates in the lodging segment, which owns and manages luxury hotels and condominiums under the Rock Resorts brand. The company also offers resort ground transportation services, making it convenient for guests to get around its properties. The real estate segment is another key area of business for Vail Resorts, where it owns, develops, and sells real estate properties. This segment allows customers to own a piece of paradise in some of the most beautiful mountain locations. Overall, Vail Resorts, Inc. provides a diverse range of businesses and services that cater to different needs and preferences of its customers. From skiing and snowboarding to luxury accommodations and real estate ownership, Vail Resorts has something for everyone. Vail Resorts Inc.'s stock price has experienced significant drops in the past year due to several key events. One major contributor was the imposition of new import tariffs by the Trump administration in April 2025, which increased costs for the resort operator that relies on European-made equipment. This led to a nearly 20% drop in the company's stock within 1 week. In addition to tariff concerns, Vail Resorts' disappointing earnings and visitation data from the 2024-25 ski season also weighed heavily on its stock price. The company reported a wider loss for its fiscal fourth quarter of 2024 and missed revenue estimates in September 2025, leading to further declines in its shares. The following year saw continued challenges for Vail Resorts stock. In March 2026, the company announced disappointing second quarter fiscal year 2026 results, which fell short of analyst expectations for both earnings per share and revenue. This was largely due to historically low snowfall in the Rocky Mountains, warmer temperatures, and reduced terrain availability, leading to an 11.9% decrease in skier visits. These events have cumulatively contributed to a decline in Vail Resorts' stock price, with some drops exceeding -7.53%. The company's struggles are likely linked to a combination of factors, including trade policies, geopolitical anxieties, and weather-related challenges. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline in the ski industry can be attributed to several key factors. Revenue growth is primarily driven by improved weather conditions and increased sales at Australian resorts, resulting in a significant increase in pass product revenue. Additionally, increased visitation at these resorts has led to higher non-pass revenue. In contrast, North American resorts have experienced revenue decline due to historically low snowfall totals, leading to decreased skier visitation and subsequently lower demand for ancillary services. The mountain segment is the largest contributor to revenue, with lift ticket sales accounting for 62% of its revenue. Pass product sales also play a significant role in this segment. The demographic mix of guests, with destination guests purchasing higher-priced lift tickets and utilizing more ancillary services, further contributes to revenue growth. However, the geographic mix of guests, with regional ski areas attracting local visitors who tend to spend less, can hinder revenue growth. In contrast, the lodging segment has experienced a decline in revenue, with owned hotel rooms decreasing by 6% year-over-year and managed condominium rooms decreasing by 8%. The real estate segment's net revenue is also affected by gains or losses on the sale of real property. Overall, these factors highlight the importance of weather conditions, demographic mix, and geographic location in driving revenue growth or decline in the ski industry. The net income of the company experienced a significant decline in 2026 compared to the previous year. The decrease was approximately $31.1 million, representing a 12% drop. This downturn can be attributed to various factors, including delayed resort openings due to historically low snowfall across the western U.S. The impact of these factors is evident in the quarterly results. For the 3 months ended January 31, 2026, net income decreased by $34,000 $369, a decline of 14% from the previous year. The 6-month period also saw a substantial decrease, with net income dropping by $47,866, or 67%, compared to the same period in 2025. In terms of profit margins, there was an increase in total segment operating expense as a percentage of net revenue. For the 3 months ended January 31, 2026, this ratio rose to 61.2%, up from 60% in 2025. Similarly, for the 6-month period, the ratio increased to 79.4%, compared to 77.7% in the previous year. The increase in operating expense as a percentage of net revenue suggests that the company's ability to maintain profitability was compromised due to various factors, including delayed resort openings and low snowfall. This had a direct impact on the company's net income, leading to a decline in both quarterly and 6-month periods. The company's financial performance indicates a positive trend in its operating cash flow. According to the extracted summary, the company has generated significant amounts of net cash from operating activities. Specifically, for the 3 months ended January 31, 2026, the company reported $1,234,119 in net cash provided by operating activities. This positive trend continued into the 6-month period, with a net cash provided by operating activities of $575,850. These figures demonstrate that the company is successfully generating positive operating cash flow, indicating a strong financial position and ability to meet its obligations. The company's debt level has undergone significant changes over the past period. Total debt has increased from $4,719,041 to $5,023,981, while long-term debt net has risen from $2,128,064 to $2,594,765. Furthermore, total debt has surged from $1.93 billion to $2.93 billion, and net debt has increased from $2,227,022,000 to $2,546,021,000. In terms of interest expenses, there has been a notable increase. For the 3 months ended January 31, 2026, interest expenses rose to $49.5 million, up from $42.7 million in 2025. Similarly, for the 6 months ended January 31, 2026, interest expenses reached $100.8 million, compared to $85.5 million in 2025. This represents a significant increase of $15.3 million over the same period last year. Overall, both debt levels and interest expenses have seen substantial changes, indicating a notable shift in the company's financial situation. The recent performance of various segments and regions in the industry has been mixed. One area that struggled was the North American segment, which saw underwhelming results. The lodging segment also performed poorly, with its related mountain segment also experiencing difficulties. In contrast, there is limited information available on several other segments and regions, making it challenging to assess their performance. These include the mountain, lodging, real estate, European, and Australian ski areas segments. Without more data, it's difficult to determine whether these segments are thriving or struggling. Management is optimistic about the company's outlook despite challenging conditions. They expect their operating model to remain strong and are focused on initiatives within their control, such as advanced commitment strategy, investments in resorts and employees, and optimizing visitation. To mitigate weather-related impacts, the company sells past products prior to the ski season, providing a stable stream of lift revenue. The company is also pursuing opportunities with third-party developers for real estate projects, limiting financial risk. Management believes that existing cash and cash equivalents, along with expected positive cash flow from operating activities, will provide sufficient liquidity to fund operations. To drive incremental past product sales and visitation, the company is investing in media spending, prioritizing marketing and sales efforts. Management anticipates that the mountain and lodging segment will continue to be a significant source of future operating cash flows for at least the next 12 months and thereafter. The company plans to utilize existing cash, borrowings under credit agreements, and future operating cash flows to complete its capital plans. Overall, management is confident in the company's ability to meet liquidity needs through a combination of existing resources and expected cash flow from operations. The The company has a history of rewarding its shareholders through various means. One such method is by paying out cash dividends. As per the provided information, the company has indeed paid cash dividends in the past. For instance, for the 3 months ended January 31, 2026, each share received $2.22, while for the 6 months ended January 31, 2026, the dividend amount was $4.44 per share. In addition to paying out dividends, the company has also been actively involved in buying back shares from the market. According to the data provided, a total of 11,382,892 shares have been repurchased since inception. This indicates that the company is committed to returning value to its shareholders through both dividend payments and share buybacks. That concludes the financial summary for Vail Resorts Inc. Feel free to comment below, and I will be happy to answer them when possible.